The moment before a major turn never feels dramatic. It feels confusing. According to some analysts, silver now sits in that exact space, caught between neglect and anticipation, dismissed as dead money by some and quietly reassessed by others. Prices hover without conviction. Narratives contradict each other. And yet, this is precisely the environment where historical shifts tend to begin. Here's what nobody tells you. Markets don't turn when consensus is clear. They turn when no one agrees on what matters anymore. This is where the pattern begins. Silver's long-term behavior follows a recurring cycle that stretches across centuries, not years. Stage 1 is accumulation, when interest disappears and prices stagnate. Stage 2 is disbelief, when early moves are ignored or explained away. Stage 3 brings leverage, as speculation returns and conviction hardens. Stage 4 is volatility, where gains and losses accelerate together. Stage 5 is resolution, often violent, where excess is cleared and the cycle resets. Silver has moved through these stages repeatedly, each time under different headlines but with the same internal rhythm. The late 1970s offer a clear case. After years of inflation, currency instability, and eroding trust in monetary authorities, silver began to rise quietly. By 1976, prices were still under $5 an ounce. Few cared. By 1979, momentum built rapidly as inflation surged into double digits and confidence in fiat money collapsed. The move accelerated when leverage entered the system. Futures, options, and concentrated bets amplified demand far beyond physical supply. In January 1980, silver briefly touched nearly $50 an ounce. At first, it looked like a miracle. Then the bill arrived. Margin rule changes, forced liquidations, and collapsing confidence drove prices down more than 80% in months. Opportunity and risk had been inseparable. The next major cycle emerged decades later. After years of underperformance, silver entered the 2000s deeply discounted relative to other assets. When the global financial crisis erupted in 2008, confidence fractured across markets. Central banks expanded balance sheets aggressively. Interest rates fell toward zero. According to some economists, this environment revived demand for tangible assets. Silver initially fell with everything else during the panic, then rebounded sharply. By 2011, it surged past $48 an ounce, echoing its 1980 peak. Everyone thought they were safe. They weren't. Once again, leverage, speculative enthusiasm, and crowded positioning transformed opportunity into fragility. What followed was not a crash in the traditional sense, but a long erosion. From 2011 onward, silver entered a prolonged period of disappointment. Prices drifted lower, volatility faded, interest evaporated, capital moved elsewhere. This stage is often misunderstood. It is not failure, it is digestion. According to some analysts, extended periods of underperformance are how markets shed excess narratives and reset expectations. Silver spent years in this quiet phase, slipping out of public consciousness, while structural forces slowly shifted underneath. Here's why this matters now. Modern conditions rhyme with the past without repeating it exactly. Global debt levels are significantly higher than in 2008. Energy transition policies have increased industrial demand for silver in ways that didn't exist in earlier cycles. At the same time, monetary credibility faces persistent questions as inflation proves harder to contain than expected, not certainty. Pressure. According to some scenarios, these forces place silver back into the early stages of a familiar cycle, even if prices have not yet confirmed it. The danger wasn't what people saw, it was what they ignored. When assets sit quietly for long periods, risk feels low. In reality, risk is often being transferred invisibly. Positioning thins. Liquidity dries up. Small changes begin to matter more. This is the stage where silver historically becomes most misunderstood. Critics point to its lack of momentum. Advocates point to its asymmetry. Both miss the timing problem that defines every cycle. The unresolved question hangs in the air. Is silver still trapped in accumulation and disbelief, or is it already slipping into a new phase of leverage and volatility? According to some analysts, the answer won't come from forecasts. It will come from behavior, how markets react to stress, policy shifts, and unexpected shocks. The pattern never announces itself clearly at the start. And that uncertainty is exactly what makes the next stage dangerous, or extraordinary. If the pattern holds, what follows confusion is not clarity, but acceleration. According to some analysts, silver's turning points only become obvious in hindsight, when price action forces narratives to catch up. The period after 2011 illustrates this perfectly. Following the sharp decline from its peak, silver didn't reset quickly. It drifted. For years, it traded sideways and lower, underperforming equities, cryptocurrencies, and even other commodities. Capital avoided it. Media ignored it. This was not collapse. It was exhaustion. And exhaustion is how cycles quietly prepare the ground for what comes next. This is where historical case #2 truly resolves. After the post-crisis surge, the monetary environment appeared to stabilize. Central banks signaled control. Inflation fell. Risk assets boomed. Silver, tied psychologically to crisis hedging, lost its appeal. From 2012 through the late 2010s, it remained trapped well below its highs. According to some economists, this phase flushed out speculative excess more thoroughly than any single crash could have. Leverage declined. Expectations shrank. The asset became boring again. That boredom is not an accident. It is structural. Then comes the third act, one that rarely looks dramatic at first. Following long neglect, silver entered a phase of structural neglect rather than speculative failure. Investment dried up. Exploration slowed. Mine supply growth stagnated. At the same time, new uses quietly emerged. Electronics grew more complex. Renewable energy expanded. Medical and defense applications increased. Demand didn't explode, but it became persistent. This is where the pattern repeats across decades. When supply responds slowly and demand changes structurally, price eventually stops reflecting only sentiment and begins reflecting constraint. Here's the mechanism that ties past cycles to the present. Markets oscillate between underestimating and overestimating risk. During long expansions, they underestimate systemic stress and overestimate stability. During crises, they do the opposite. Silver's role has always been to expose those errors, not by predicting collapse, but by reacting disproportionately when confidence shifts. According to some scenarios, today's environment resembles the early transition between stages, rather than the climax. Inflation is not runaway, but not gone. Growth is not collapsing, but uneven. Policy credibility is not lost, but questioned. Applying the 5-stage framework conditionally clarifies the fork ahead. In a soft landing scenario, economic growth stabilizes, inflation moderates, and silver remains range-bound, offering modest returns but limited drama. In a reset scenario, periodic shocks, policy mistakes, energy price spikes, financial stress push investors intermittently toward tangible assets, lifting silver with volatility but without sustained mania. In a hard break scenario, trust fractures more deeply, leverage re-enters aggressively, and silver accelerates rapidly before instability forces another resolution. None of these paths are guaranteed. All are plausible within the same structural setup. Here's what nobody tells you about opportunity versus risk. They are not opposites. They are the same thing viewed at different moments in the cycle. Silver becomes most dangerous when it looks safest, and most attractive when it looks irrelevant. Not cheap. Asymmetric. According to some analysts, the real question is not whether silver will rise or fall, but whether participants understand which stage they are actually in when they commit capital. This is where the trap closes for many observers. They wait for confirmation, believing certainty reduces risk. In cyclical assets, certainty usually arrives near peaks. Uncertainty dominates near turning points. Watching silver today feels uncomfortable precisely because signals conflict. Prices hesitate. Fundamentals argue one way. Sentiment argues another. That tension is not noise. It is the cycle negotiating its next phase. The final tension remains unresolved. Silver stands at a crossroads where history suggests movement is inevitable, but direction remains conditional. If the pattern applies, the next phase will not announce itself politely. It will arrive through volatility, narrative shifts, and sudden revaluation of what once seemed dull. Those positioned too early may endure frustration. Those positioned too late may endure damage. And somewhere between risk and rare opportunity lies timing, the one variable history never reveals in advance, but always judges in retrospect.